Well, hello everybody. This is Professor Lanzafame, and today we're going to be discussing how to record journal entries. And the difference between previous recordings and this one is that this time we're actually going to do what people refer to as bookkeeping. We're going to record information into the general journal. We will then post the information into the general ledger, and then we will conclude by doing a trial balance to make sure we are in balance from the procedures we have followed. Okay, so just want to give you a little bit of a heads up of where we're going. In front of us, we have a general journal, a general ledger, and a trial balance for us to fill out. And as we go through the process, hopefully you will understand every little step of the way. Keep in mind that in order to succeed in bookkeeping or accounting, you still have to know your rules. So I'm just going to scroll down a little bit and show you some of the rules that we've discussed in previous chats. And if you can see from the information that I have, you will notice over to the left we have our little tips and tricks. We have our debit date accounts. Remember that assets are things that you own, and assets go up by a debit. Drawing is when the owner takes money out of the business for personal reasons. That also goes up by a debit. And expenses, these are your costs to operate the business. They also go up by a debit. Three completely different things. They just happen to go up by a debit. Okay, so the other accounts, immediately underneath there, you see the liquor accounts, liabilities, capital, and revenue. The liquor accounts are basically, they basically work the opposite of debit date accounts. They increase by credits. So liabilities represents the debts of the company. Capital represents when the owner makes a personal investment into the business, basically takes something of personal value and gives it to the business. Usually it's in the form of cash. And then you have revenue. Revenue is when you perform a service. And all of these things are detailed over to the right underneath my shopping cart. Speaking of the shopping cart, you will notice that there are certain accounts. Of the 6 that we talked about in debit date and liquor, 4 of them always go up. In fact, I refer to these accounts that always go up as my shopping cart accounts. Because if you remember, if you're shopping, let's say you're on a shopping spree, you're racing through the aisles and you're just filling your cart with everything you can possibly find. Well, in our little made-up store, we have basically drawing accounts, expense accounts, capital accounts, and revenue accounts. These are the only things that are on the shelves, and these are the only things you can put in your shopping carts, because these are the 4 items that always go up. If you notice over to the left where I have the debit date and liquor drawings, you will notice that next to drawing and expenses, I have a black filled in area where that account would go down. Same thing with capital and revenue. Notice on the debit side, I have a black filled in area where those accounts would go down. So basically, I'm telling you, these 4 accounts always go up. Will they ever go down? Yes. If you ever make a mistake, you need to fix something, then you would do the opposite. But assuming things go according to plan, you should never ever see those accounts go down until you close the books. And when we get to chapter 4, we'll talk about how to close the books. We'll venture off into the dark side. But till then, only assets and liabilities fluctuate up and down. So assets and liabilities you can increase and decrease. Therefore, debit and credit, or credit and debit. But drawing and expenses, always debit drawing, always debit expenses, always credit capital, always credit revenue. Just remember those rules. When you get into a tough jam, remember those, and hopefully you'll be able to figure out what to do. Looking underneath my little diagrams of debit date and liquor, you will notice I also have some little tips and tricks just to kind of help you along the way. What I would recommend is that you print out a copy of this document before we start doing the transactions so that you can have these rules right at your fingertips. Okay, so that's what you should do before we move on. Take a few minutes, print this paperwork. It's not exactly printer ready, so you may have to kind of massage the printout a little bit so that everything comes out exactly the way you want it. Maybe print a page, fit one everything on one page if you can read that small of a print. but I would recommend that you print this as soon as possible. And then we can get ready, pause the video, and then when you're ready, we'll start up again. In the meantime, notice I have over at the bottom left, minimum of 2 moves, at least 1 debit, and at least 1 credit. Every time you do a journal entry, every time you work in accounting, 2 sides have to equal each other. In order to have 2 sides equal each other, you need something on one side and something on the other side to balance. So you need a minimum of 2 moves. Those moves will be translated into at least 1 debit and at least 1 credit. Your debits have to always equal your credits. Remember that the first time you use an account, that account must go up. So if it's a debit account, assets, drawing, expenses, those accounts always go up by a debit. Liquor accounts, if you use a liquor account for the first time, liability, capital, revenue, the way those accounts go up is by a credit. So the first move in one of those accounts has to be positive. You can never have a negative balance. The books are always done from the company's eyes, not from the owner's eyes, from the company's eyes. So you're always doing, what's going up or what's going down from the company's perspective, not from the owner's perspectives. Whenever you see the word paid, remember to always credit cash. So if you see the word paid, instantly half your job is done. I have my credit. I have to credit cash. All I got to do is figure out what to debit. And typically is, well, what did you pay? And then that should easily be your debit. So remember, your shopping cart accounts always go up. And then I just rewrote the rules down below. Notice how assets can be debited or credited. Liabilities can be debited or credited. But expenses and drawing always get debited. Capital and revenue always get credited. So if you can remember those little rules, awesome. It's going to make our job real easy. So let's go ahead and start doing the transaction analysis. And basically, we're going to analyze these transactions and we're going to enter them onto the journal and then post them into the ledger. And we will do this journal to ledger, journal to ledger, journal to ledger, back and forth until we're done. In fact, if you look to the right of your screen, you will notice that I have in yellow the 3 steps that we have to follow to do this procedure. Step number 1, enter transactions into the journal. Step number 2, after each general journal entry, you must post immediately to the general ledger. So we're doing step 1 and 2 simultaneously throughout the problem. And then when we're done, we'll complete that trial balance that you see there. And that says, after all transactions are complete, copy final answer from each general ledger account, that document that's in the middle of the page. The final answers will get copied into the trial balance. Okay, so what I've done is I've already filled in a little bit of the trial balance in terms of account names and numbers. I even went so far as creating a document in the journal and the ledger to color code what we're doing. So the first transaction you see in yellow, you see where it gets copied into the ledger into those yellow rows. Second one is green, you see where the green ends up, so on and so forth. So I thought this would be real helpful for us to follow. We're going to use the current year 2016. If you're working out of the textbook Accounting Principles 12th edition by Wiley, you can turn to page 84 and you can follow along. If not, just listen carefully and I'll explain what the question says and you can see the moves that I'll be making. So the problem starts off by saying Emily Valley is a licensed dentist. During the first month of operation of her business, the following events and transactions occurred. Okay, this is happening in April. This is 2016. First transaction is on April 1st. Okay, and on April 1st it says invested $20,000 cash in her business. Invested. If you ever see the word invest, ding, 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 that means you got to use capital. So remember, we're doing the books from the company's eyes. What is the company getting from the owner? Well, the owner just invested $20,000 cash into the business. So think about what we did in the first chapter. What 2 accounts are involved when the owner makes an investment? Hopefully you're thinking to yourself, it's cash and it's capital. If you've made that conclusion, excellent. So now the question is, Which one's going up? Are they both going up? Are they both going down? One up, one down? Well, here's how you answer that question. Well, cash is being put into the business for the first time. First time use of any account, that account has to go up. What is cash? It's an asset. How do you increase an asset? Debit. Remember, cash is an asset. Assets are part of debit aid. So the debit aid accounts go up as a debit. If you don't recall, look at your printout that you made. If not, real quick, let me zoom in down here and notice assets go up by a debit, one of the debit aid accounts. Capital is a liquor account. First move in liquor is a credit. Okay, so just remembering what to do there. So we're going to debit cash, and we're going to indent our credits. The owner of the company is E. Valley. If you remember, it was Emily. So E. Valley Capital. Notice that when you enter something into the general journal, you must do the debits first, and then you do the credits. That is a rule that is all over the world. So debits first, credits second. Notice that my debits are to the left and my credits are indented. So notice how once I enter the amount of $20,000, notice that my debit is to the left and my credit is to the right. So not only do my numbers look like they're staggered, debits left, credits right, but my words look staggered as well. Debit left, credit right. So you want the words to match the numbers. Your debits have to equal your credits. So now that we've done our first journal entry, we have to notice that yes, we are in balance, so we have the green light to move on. And now we want to post, which in accounting is fancy for copy. We want to copy this information into the general ledger. The general ledger is like a little mini checking account for every account that you have. The general ledger keeps track of all of the activity for an account and updates the balance as you go. So the first one we want to copy is cash. So we're going to put in the date again, April 1st. The item column is kind of like a ghost town right now, so we're not going to use it, so we're just going to bypass it. The PR column stands for posting reference, but for our purposes, think of it as page reference. The page of the general journal we just copied from. This is the general journal here to the left, and it's page 1. So what I would like you to do is put in G for general journal, 1 for page 1. So we're copying or posting from the general journal. So we'll have everything we're going to do is on page 1, so all of our PRs will be G1. If we are posting from page 12, these would say G12. So now let's copy what we did in the journal. We debited cash for $20,000. So now we're going to debit it for $20,000 in the ledger. And now let's update the balance. Since there was no previous balance, our balance in our ledger account for cash is $20,000. Now that we have completed that posting, we want to basically kind of like check, did it, cross it out, something to that effect. So what they invented in accounting was, hey, you know these account numbers? Let's put the account number of the account into the PR of the general journal. This way we know we copied it to the right account. So it's better than just putting a check mark. By putting that 101 in there, we knew that we actually posted it to the cash account. So if we put 112 in this little PR column instead of 101, we'd be like, oh my God, I posted it to the wrong spot. No, we did post it to the right location. So just a quick note about account numbers. Account numbers are somewhat arbitrary except for the first digit. The first digit really represents what category you're working with. Assets all around the world, assets start with the number 1. Liabilities start with the number 2. Let's take a look at the trial balance. It's a quick little view here. Cash, accounts receivable, dental supplies. These are all things that are owned by the company. And notice their assets, they start with a 1. We have a couple of liabilities in this problem. Accounts payable and unearned service revenue. Liabilities start with a 2. Capital and drawing start with a 3. There is no drawing in this example, but if it was, it'd be there as well. Earned revenues start with 4, and expenses either start with 5s, 6s, or 7s, just to give you a little FYI about that. Okay? So just want to give you a little bit of a heads up regarding that. So we've got stuff in the general journal. We have to post to the ledger. We posted cash. We cross-reference back with the 101 to tell our journal and remind ourselves that we put it in the right spot. Now let's go copy or post capital. So here's our capital account. Put in the date, April 1st. Leave the item blank. We're going to put G1 into the PR. And now what did we do to capital in the journal? It was a credit. Therefore, it's going to be a credit here as well. And then update your balance. And now that we have completed that, what's the next step? How do I tell my general journal that I've completed this step? Do you remember? Hopefully you do. You got to take the account number and cross-reference back. You're going to put the 301 into the PR of the journal. So we have two different PRs. We have the PR in the general ledger, which I'm telling you, think of it as page reference. But the PR that's in the general journal is in reference to the account number of the account we just posted to. A lot to remember, but it gets easier with all the repetition that we do. But the first transaction is done. We journalized and we posted. Remember, we do not update this trial balance until we're completely done with the month's activities. Okay, next transaction. If you're looking at the book, there is a transaction also on April 1st that says hired a secretary receptionist. That is not an accounting activity that we deal with, so we just ignore that transaction. If we were to pay the secretary or receptionist, then we would do something about it. But just because we hired somebody, this is a non-debit credit event, so we can ignore that. So let's go on to the next transaction, which is the second. And on the second, it says paid. Ding, 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 ding. You hear the word paid, or you're seeing the word paid. As soon as you see the word paid, instantly we know we're going to credit cash. Automatic. You see the word paid in the sentence, automatically credit cash. So let me skip the debit and let me indent the word cash. Let me reread the rest of the sentence. Paid office rent for the month $1,100. So we are going to have a transaction involving $1,100. So that means both the debit and the credit have to equal $1,100. So because of the word paid, I instantly knew I had to credit cash. So what do I debit? Well, what did they ask us to pay? Again, it said paid office rent. Well, if you're not sure, look at your ledger titles. Cash, unearned revenue, capital, revenue, accounts receivable, dental supplies, salaries and wages expense. Scroll down, accounts payable, rent expense. So let me read the question again. Paid the office rent. The only account that had the name rent in it was rent expense. So that's our answer. We're going to be debiting rent expense. Is it okay to debit an expense? Absolutely. Always debit expenses. Remember, they're one of our shopping cart accounts. Okay? Capital is an account that's a shopping cart account. Always credit capital. Rent expense, expenses are part of the shopping cart. Always debit expenses. So we have debited rent expense for $1,100, credited cash. Remember, even though I knew cash was one of the moves, it's a credit, and I always have to write my debits first. Debits to the left, credits indented. Look at the numbers. The debits are to the left, credits are indented. So now let's post. Find the rent expense, and here it is at the bottom. Date again, April 2nd. Nothing in the item. We're posting from G1. We are debiting rent expense for $1,100, and your new balance is $1,100. Once you've completed that, cross-reference back with the account number. Remember, we got to go tell the journal that we've completed this posting. So we're going to put the 729 into the PR column of our journal. That tells you, or let's say somebody was taking my spot, it was my time to leave, and the person who's taken my spot knows exactly where I left off because I filled in the PR number. So right now, if that person was taken over for me, like, oh, Sam forgot to post cash, let's make sure. And as you can see, cash has not been posted. So let's put in the date, the 2nd. Do not repeat April. Once we wrote April once, just like in the journal, you don't need to repeat that the rest of that particular journal or ledger until you start a new page. So we're also posting from G1. This time, however, cash was a credit. So we're going to credit it for 1100. So remember our rules. When it comes to figuring out if we have to add or subtract, remember that if something has a debit balance and you debit it, a debit, you add. If something has a credit balance and you credit it, credit, you add. And we have our own types of Valentine phrases in the accounting world. You know, when it's Valentine's Day, people say, oh, opposites attract. Well, in accounting, opposites subtract. So if we have something with a debit balance, which cash has, and we credit it, debit, credit, opposites subtract. So we're going to subtract these two from each other, 20,000 minus the 1,100, and our new balance in cash is 18,900. So just because I credited cash doesn't mean it has a credit balance. It still has a normal debit balance. If any of these balances in any of these accounts ever appear negative, you've made a mistake. You've screwed up. Okay? We want to always have positive balances in these accounts. So I credited cash for 1,100. Opposites subtract. That's why I subtracted. My new balance is 18,900. I now need to take the account number 101 and cross-reference back to my journal. And that transaction is now completed. Okay? Next transaction is on the 3rd. And on the 3rd it says, purchase dental supplies on account, $4,000. Okay, so what's the company getting in this transaction? They're getting dental supplies. If you're ever stuck with what to call an account, that's where the ledger comes in. The ledger has predefined titles. You can't be calling these something that you want to call them. In other words, dental supplies is the account. I just can't just debit supplies. I have to use the actual terminology that's in my ledger. So dental supplies is going to get debited, and the amount there was for $4,000. And they said we bought this on account. It's like we used our credit card. It's not cash. We used a credit card, so that would be accounts payable. And that would be for $4,000. Again, my debits have to always equal my credits. So the next step is to post. So here's our dental supplies account. It's in blue, just like my blue transaction. Already color-coded for your viewing pleasure. So we have here April 3rd. Nothing in the item. G1 in the PR column. Remember, the G stands for general in general journal, and the 1 stands for page 1. So G1, general journal, page 1. I am debiting the dental supplies for $4,000, giving me a new balance in this account of $4,000. When I'm done, cross-reference back with the 126. Next thing I want to do is credit accounts payable. Here's accounts payable right below it. Date again, April 3rd. Nothing in the item. PR is G1. I'm now crediting accounts payable for $4,000, and my new balance is $4,000. Cross-reference back with the 201. So again, I did my journal entry. My journal entry was in balance. I then posted to my ledger. I don't involve this trial balance until I'm totally done with the month. What does the trial balance do? It checks the final answers we got from every one of these ledger accounts and makes sure do our debits equal our credits one final time. Okay, let's go on to the next transaction. We are now on April 10th, and on April 10th it says performed dental services. So we're finally doing a job. We're doing what we do for a living. Whenever you do what you do for a living, it's revenue. When you perform a service, it's revenue. And it says perform dental services and build insurance companies. So we're excuse me, we're not getting any cash right now. We're just billing these insurance companies. So we know we performed a service. So service revenue is one of those accounts. Service revenue is one of those shopping cart accounts. It always goes up. It's part of liquor. How does a liquor account go up? It goes up by a credit. So let me skip the debit for a second. And we know we have to credit revenue. We have no choice. Can't debit a revenue account because revenue is the first time we've used it. First time you use an account, it has to go up. So service revenue is going up by $5,100. So let me just do something real quick. Imagine the question said, we did a job for cash. Then I would have debited cash and still credited service revenue. But they didn't ask us to debit cash because they said we performed a service and billed insurance companies. So we didn't get the cash in this particular moment. So therefore, we're waiting to receive the cash. So we're going to debit accounts receivable for $5,100. So if we had gotten cash from the customers right on the spot, we would have debited cash and credited revenue. But because we're not getting their cash, because we're billing, we're going to debit accounts receivable. So think of accounts receivable as a temporary account until you get the cash. So let's post. So we're going to debit accounts receivable. This is on April 10th. Nothing in the item. G1. We're going to debit accounts receivable for $5,100, and your new balance is $5,100. Cross-reference back with the 112. Then we also want to update our revenue count. Again, the date is April 10th. G1, we're going to credit our revenue because we always credit revenue. And our new balance in that account is also $5,100. But the difference is this one's a $5,100 credit balance. The one in accounts receivable is a $5,100 debit balance. Why? Because accounts receivable is an asset. Assets carry debit balances. Assets are part of debit aid. Debit accounts, debit balance accounts. Liquor accounts have credit balances. Debit aid accounts have debit balances. Okay, one last step. I need to take that account number of 400, cross-reference back to my journal to indicate that process is completed. Next transaction is April 11th. And according to the textbook, it says, received $1,000 cash advance from a customer for an implant. So we did a dental implant, or we're about to do a dental implant for this customer, and the customer says, hey, can I give you the money now? Because I know in a month from now I won't have it. I want to give you the money up front. So we're going to collect this customer's money. So we're going to debit cash for $1,000. But because we haven't performed the service, we owe the service. And whenever you owe a service, whenever a customer prepays you for a job that you haven't done yet, you're going to credit unearned service revenue. And that would be for $1,000. Okay, so let's post. Let's go update the cash account. Date is the 11th. G1. We're going to debit cash for $1,000. So our cash is going to go up by 1,000. So now we're sitting at 19.9. Cross-reference back with the 101. Unearned revenue, first time we used it, has to go up. Unearned revenue is a liability. Liabilities are part of liquor. First time you use a liquor account, it has to go up. So this had to be a credit. So the date, April 11th, G1, we're going to credit that unearned revenue for 1,000, and your new balance is 1,000. Cross-reference back with the 209. Okay, we're now on the 20th. All right, on the 20th it says received $2,100 cash for services performed. So you think about this here for a second before I start typing. You did a job and got money. Back on the 10th, you did a job, but you didn't get the money. This time you did. So if we did a job, automatically you should be saying, I think that's revenue. You sure are correct. So we know if it's revenue, we got to credit revenue because you always credit revenue. So then what do we debit? Well, the question said we received money. We received cash. So you're going to debit cash. And again, this amount is for $2,100. So look at the difference between the 10th and the 20th. Both cases, we performed a service. The difference between the two, this time we got cash. The first time, we didn't get the money. We were waiting to receive the money. That's why we debited accounts receivable. Okay, so let's post. On the 20th in cash, G1, we are going to debit cash for $2,100. And our new balance, it's going up. We like it when our cash balance goes up, right? Our new balance is now $22,000 in cash. Cross-reference back with the 101. Now let's find our service revenue and update that account as well. Date is the 20th. G1, we're going to credit this account for $2,100. We have a credit balance and we're crediting the account. Credit, we add to get our new balance. Our new balance in revenue is now $7,200. Cross-reference back with the 400. Only 2 more transactions to go and we're done. Next one says on the 30th. It says paid the secretary for the month, $2,800. So we're going to pay. Ding, ding, ding. You see the word pay. Ding, ding, ding. You're going to credit cash. Every time you see the word paid, you're going to credit cash. I don't care what the heck you're paying. If you see the word paid, instant success in terms of remembering what to do. So we know automatically because it said paid, we're going to credit cash. Question is, what do we debit? Well, what did we do? We paid the secretary receptionist for the month. We paid their salary. So if you scan through the ledger, the only account that fits that bill is this account called Salaries and Wages Expense. So that's what we'll use. Salaries and Wages Expense. And we're going to debit that for $2,800. Again, notice our debits equal our credits. So let's post. First time we're in Salaries and Wages, so I got to write April 30th. G1. We're going to debit this account for $2,800. And our new balance is $2,800. Cross-reference back with the 726, reminding our journal that we have completed the posting process. We actually copied it. And then update your cash. Balance in cash currently is $22,000. Let's see what happens now. We post on the 30th, G1. We're crediting cash for $2,800. Remember, cash is an asset, carries a debit balance. I'm crediting something with a debit balance. Remember Valentine's accounting day, and that is opposites subtract. So 22,000 minus the 2,800, our new balance in cash is 19,200. Cross-reference back with the 101. Finally, the last transaction in this problem, on the 30th, one last time, it says paid. Ding, ding, ding. I won't even read the rest of the sentence. It just says paid. So what do you do as soon as you see the word paid? That's right. You got to credit cash. So credit cash for $2,400. So now the only thing we got to figure out is what do we debit for $2,400? And let me spell cash properly. So let me read the rest of the question. Paid $2,400 for accounts payable due. So we're making a payment on our credit card. So we are going to debit accounts payable. Remember, you always have to write the debits first and then the credits second. That is a universal rule all over the world. Debit accounts payable, credit cash in this case. So let's post. Accounts payable is kind of like below the list here, below the screen. Date is the 30th. Remember, we already owed $4,000 on our credit card, and we just made a payment of $2,400. So what happens when you make a payment on your credit card balance? Your credit card balance goes down. Accounts payable is a liability, and it has a credit balance. I'm debiting it. Opposites subtract. Remember the accounting Valentine's Day. So opposites subtract in effect here. Cross-reference back with the 201. And then finally, we need to update cash. Date was the 30th. G1. We want a credit cash for $2,400. And opposites subtract again. Cash is an asset, carries a debit balance. I'm crediting the account, therefore I have to subtract. Okay, we have completed all the transactions that are in problem 2-2A. So now what we're going to do is we're going to take these final balances that you see in all of these accounts, and we're going to copy them to our trial balance. The only trick to doing the trial balance is you've got to remember your debit and your liquor. You've got to know which of these accounts have a debit balance and which of these accounts have a credit balance. So remember, debit accounts, assets, drawing, and expenses. They have debit balances. Liquor accounts, liabilities, capital, and revenue, they carry a credit balance. So here goes. Cash, we know, is an asset. That 16.8 means debit balance because it's an asset. So I'm going to copy that 16.8 right into my trial balance. Okay, and let me make this a little bit bigger here so you can see it. There we go. And let me make this credit column a little wider as well. Okay, accounts receivable, also an asset. Carries a debit balance, $5,100. The next one is dental supplies, also an asset. Carries a debit balance. Assets, along with drawing and expenses, always carry debit balances. Next one is accounts payable. Accounts payable is a liability, and liabilities carry a credit balance. Here it is, $1,600. We enter that into the account. Okay. Unearned revenue, another liability account. I owe someone a service. So that's going to be a credit balance. Capital, Emily Valley Capital. Capital is part of liquor. It too carries a credit balance. You got to know your debit and your liquor if you want to end up putting these in the right spots. Revenue, another liquor account. $7,200. Then we've got salaries and wages expense. It's an expense, therefore it's part of debit aid. Expenses, debit aid accounts carry debit balances. And finally, the last one, rent expense. It's an expense account, carries a debit balance. And lo and behold, take a look at our trial balance. We are in balance. Notice that we've got $29,800 on the debit side. We have $29,800 on the credit side. We are in balance. No guarantee that we didn't screw up. I could have accidentally put, something that was supposed to be in, let's say, service revenue. I could have accidentally put in unearned revenue, and my debit still would have equaled my credits. But if I wrote a number wrong, did math incorrectly, this trial balance will tell me what I did wrong. Okay? So to recap, we did journal entries, we posted them to the ledger, and then we did that back and forth action throughout the problem. And then when we were finally done, we then created our trial balance. What is a trial balance? It is a summary of your general ledger. So we took the final balances of each ledger account, entered them into the trial balance, into their corresponding debit or credit side. Remember, debited accounts carry debit balances, liquor accounts carry credit balances. And then we did our math. Notice the first number in each column gets a dollar sign. Our final numbers get dollar signs. Our final numbers have math lines above them, double lines below them. The double line shows conclusion. And that is it for today. So hopefully this was nice, short, and sweet for you. I would recommend going back and rereading the chapter if you're not 100% sure, but I would go back and practice and see this video as often as you need to till you get it down pat. But if you're having trouble with any of this stuff, it may be related to the stuff you learned in Chapter 1. Remember, what is an asset? Something you own. If you can't remember that accounts receivable is an asset, Chapter 2 here is going to give you issues. So you got to know where your weaknesses are and take care of them so that you can move forward with the remaining stuff. Okay? So remember debit aid, remember liquor, and again at the bottom of the screen you see the debit aid and liquor accounts, and of those 6, 4 of them always go up, which are the shopping cart accounts. Okay? And that's all I have for you today. Next video will be a continuation of this problem. We're going to pick up with this Valley Dentistry trial balance, and we're going to see how to do the financial statements off of this trial balance. All right, till then, we are done. Take it easy. See you next time. Bye-bye.